Going to get the spoken word now on this bull rally with our chief equity strategist, John Blank, who joins me via Skype from the West Coast in LA. John, the last time you and I got together like this to talk about the market, since then we've seen a lot of different issues crop up. We've seen Ebola, we've seen ISIS, we've seen issues in the Ukraine, but nothing seems to be able to kill this bull rally. What do you think? Is there something out there that can?
Terry, I think through the end of the year, we're looking at Santa Claus rally, and I would look at 2070 on the S&P as fair value by the end of the year. To me, Ebola, ISIS, or ISIL, and Ukraine are geopolitics, Terry, and the market's grown to accept that as noise in the background until otherwise noticed. And this is very different than the first half of the year. This market has figured out the geopolitics really doesn't always turn out poorly for you, and it's learned that from the oil price, which has now gone from 107 when ISIL showed up to now less than 80, $77 a barrel on West Texas Intermediate.
Okay, I'm going to circle back to oil in just a little bit. Still on the market, all of the volatility that's taken place over the past 30, 40 days seems to indicate that because of the seesawing, investors are kind of reluctant to make a decisive move in one direction or another. What do you think?
Terry, I think, looking at it from a global markets perspective, the United States is clearly where the strong growth is and the lowest risk is, and that has really been a driving force for keeping this market going. And right now you have a recession in Brazil and a lot of shorting of that market. You've got a 50% plunge in the Russian ruble, a lot of shorting of that market, and you've got very little positive news coming out of Europe, and even the Japanese story is more yen related than it is stock market related. So at the end of the day, the spot that looks best for an investor, whether a fixed income investor or an equity investor, is the United States. That's drawing the money in, and that keeps the bull rally going.
You posed the question, John, in something that you wrote not long ago. Should investors be scared about falling oil prices? Let's get back to that. Let's talk about those falling oil prices. Does the oil price drop that we're seeing imply a slowdown in the global economy?
No, it doesn't, Terry. It speaks to more consumption availability for any country that doesn't depend on oil. For the downside, you've got an S&P 500 that used to price at $133 a share for 2015. Now it's fallen $3 a share to $130 because of the cuts to the energy producers. That's only 2 or 3% of a cut in terms of earnings from the supply side. So a place like the United States, where we do have big energy companies, we're such a big consumer of energy that it's a net positive. And again, it's distributed globally. So anybody, whether it's Australia, China, Europe, Japan, all the big consumer nations get a benefit here, and that's a very democratic form of stimulus. It's not like quantitative easing. We all get it. It's broadly distributed directly to consumers, and that's going to keep this market going too.
So should investors be concerned about the oil price drop?
They should stay away from energy stocks right now, Terry. That there still is the presumption that this market can go to $70 a barrel before it turns around. And right now we're at $77 a barrel. So there's another 10% drop that can come into the fundamentals for the oil companies, whether they're drillers, E&P companies, integrateds, you name it. So I would stay away from energy companies right now. It's a great time for a long-term investor to buy a stock in the energy sector, but you've got to hang in there 2-3 years. And you are certainly probably see even lower prices for some of these shares.
Finally, John, several beaten-up sectors have rebounded nicely lately. You say the strongest X-ranked S&P 500 sectors are healthcare and IT.
That's correct, Terry. These are the sectors that don't depend to a great deal on anything other than cash flow and strong demographics. So you've really got a very strong consensus from chief investment officers that you want to stay in these areas, and they don't feel either of those sectors is too richly valued. So you've got a growth profile that's strong, but most of all, you've got very strong cash flows in these areas and strong demographics and companies that are being bid up without a worry of overvaluation, which is felt in the consumer discretionary space a lot more.
Thanks, John. There you have it, the spoken word on this bull rally with our chief equity strategist, John Blank. And with John, I'm Terry Ruffalo.